So this week in my newsletter, I wanted to talk about how mortgage lenders quote rates specifically related to escrow accounts. And you may be thinking, well, what is an escrow account? And an escrow account, basically, the easiest way I can explain it is every time a borrower makes their monthly mortgage payment, typically, they also pay taxes and insurance when they make that payment. Taxes and insurance aren't a monthly bill, they are an annual bill. And so therefore, when you make your payment, the taxes and insurance paid, that money is collected in this account called an escrow account, which this account eventually pays your one-time annual bill for taxes or insurance, eventually when they're due later in the year. So when it comes to quoting rates, how this is specific to how it impacts my rate quotes to people is that lenders want you to have an escrow account with them. They want to hold the responsibility of collecting the funds and paying your annual taxes and insurance bills. Personally, I have an escrow account on my home, and I think another point to be made is that you can actually get an escrow analysis. This allows you to see how much money is in your escrow account when the lender actually pays your tax bill or your insurance premium, and allows you just to get a little bit more transparency about how the whole process works. And I recommend you do that. And one of the pain points for people of this topic is that, well, in the past, and for some of my clients, I've seen it happen where the tax bill or insurance premium, the payment is actually delayed by the lender. It's not paid quite on time, and it causes a few phone calls and emails for it to get resolved. And my first recommendation is that regardless of the lender essentially being responsible for it, you should always track when your tax bill and an insurance premium is being paid. And I would even go a little bit further, because in the Outer Banks, it's common that your house may have flood insurance, especially if it's required if you're in a flood zone. And you would definitely want to make sure your flood insurance is paid, because lenders, as a recourse, if your flood insurance is never not paid, they will actually put forced place flood insurance on your home, and you lose the opportunity for the most competitive rates when you do that. So you always want to make sure your flood insurance is paid if you're in a flood zone and it's required. So that's really important to note. When it comes to the other pain points for people of, well, the lender was responsible for paying my tax and insurance, but they didn't pay it on time. And so I've had this experience in the past, and I don't want the lender to handle my taxes and insurance. I want to pay it one time out of the year and not put money in an escrow account. And the answer to that is you can do that, but that's going to affect your mortgage rate. And this applies whether it's a refinance, a purchase, or new construction. They all have this recourse that if you choose not to escrow with them or with the lender, then there's a fee for it. And I'm always really surprised to see people's faces, or they kind of gasp when, oh, there's a fee for not agreeing to escrow. I think that's unfair. And I know people may feel that way, that we're just looking to, or lender's just looking to give them another fee for something, but it legitimately is a revenue stream for a lender. You know, having an account, if you're a bank, and ways that banks make money is having deposits. If you're taking away an escrow account, you're taking away a deposit. So therefore, that's hurting the lender. And the lender wants an escrow account to make money. So there's a fee not to escrow, and that affects your rate when you quote it. And you may be thinking, well, Alex, what is the fee to not to escrow? And it really does depend on the loan amount. If you took a $500,000 borrow or loan size, the fee typically is a quarter point or 3/8, which is a quarter point on $500,000 borrowed is $1,250. So it's not just some $50 fee that you pay not to escrow. It's actually, a $1,000 fee. It's pretty sizable. And that's hence why my personal mortgage, I actually escrowed, because I didn't want to pay this $1,000 fee. Essentially, I wanted to avoid the fee. And so I just gave in and said, I'm going to let the bank handle it. But I think it's important to note, and I do it myself, that I track when my tax bill is paid and when my insurance premium is paid, because I want to make sure that I don't have those issues. And it's just part of the mortgage business or banking, is that lenders want deposits. And if you remove that deposit, which is an escrow account, there's just simply going to be a cost for it. And it's common that I'll talk to people, of course, my borrowers in the Outer Banks are near retirement age. And it's typically not their first mortgage. They've had 2 or 3 mortgages. they may have 5 or 6 mortgages and own a couple properties. And therefore, they've had this experience before of getting a mortgage, and I tell them that there's a fee to not escrow. And they're often, well, 5 years ago when I got a mortgage, that wasn't a consequence. I didn't have to pay a fee not to escrow. And that might be true. Maybe the lender didn't tell you about the fee. But every business, you could take to any analogy. And I think a car shop's a really simple one. I'm about to get my car inspected. And so if I'm sure there's going to be solicitations out there for car shops about if I get my car inspected and my oil change at the same time, that I'm going to get some type of discount. And it's the same thing for lenders when it comes to quoting rates. Just because they didn't tell you about the fee of not escrowing doesn't mean there's not a cost for it. And so there's always a cost for it. Whether the lender told you or not about it, there is a cost not to escrow. And of course, if the lender really wants the business, they may not just tell you about this fee and just waive the fee behind the scenes so they can continue to keep you as a client. I can totally understand not wanting to escrow, especially if you own multiple properties. If you own 5 or 6 properties and each escrow account has $5,000 to $10,000 to pay your future taxes and insurance, that could be $25,000, for example, within different accounts. And that money might be used better for you in different ways, not just sitting in essentially a checking account waiting to pay your tax and insurance for your property. So I think for real estate investors, I can totally see not wanting to escrow. But if it's a primary residence or your second or third home, I personally see that I probably wouldn't want to pay a large fee of $1,000 or so not to escrow. And so I probably would just fold my tent and say, I'll escrow and it's not that big a deal. And for the most part, especially with technology these days and reminders that people get, I know my company that I pay the mortgage to, they send out a confirmation of when you pay your tax bill or insurance bill, or when they pay it for you in your escrow account. So I do think there's a better efficiency in our way to pay your taxes and insurance when a lender does is responsible for your escrow account. But it's just part of the mortgage business or a part of banking that they're going to give incentives for better rates when you escrow. If you don't escrow, there is going to be a fee for it. And I just want to clarify for people in the future that do want to work with me and that are asking me questions, that this video can kind of give some transparency about that process and why things are a certain way. I hope you find it helpful. Please like the video, subscribe to my channel, and we'll talk to you next week.